Thank you, and many thanks to Thomas Schäfer, and of course I very much look forward to working together with you on broadening and expanding the financial market in Frankfurt and working on all the challenges that are ahead of us in terms of Brexit. And of course, it's a great honor for me to be here and to be able to speak, and a very great honor to be allowed to speak ahead of Jérôme Dijsselbloem. I'm a great European, and one of my first biggest challenges is to try to participate, to continue the work that Jérôme did as president of the Eurogroup, who laid the foundations of a lot of the things that we're working on now in terms of the banking union and the capital markets union. And it's really one of the more fascinating angles of my work to be allowed to contribute to that effort. So on the motto of today, there is nothing permanent except change, is a big statement and motto by Heraclit, and I think we have all come more than once across the truth of that paradox in our daily work and in what we're doing. I can certainly confirm the validity of it in both of my prior work and my current work, as I'm still transitioning and adapting myself to the changes of in my own life, including the relocation to Berlin a couple of weeks ago. But I have to say I'm very happy to be here today to see so many familiar faces and to, in a new role, be able to visit Frankfurt again, as I'm doing very often. One of the areas of my responsibility is financial markets, so needless to say, I spend a lot of time in Frankfurt and will continue to be doing so. The financial services sector has obviously been a great driver of change, both in technology and social change, financier of the real economy, and this progress is something that we're committed to continuing. Financial companies are early adopters of developments like digitization and globalization, and among the first industries to identify the abundance of opportunities that are involved in these processes. However, sometimes the changes and challenges are not unambiguously good. We've seen many of those aspects during the financial crisis, and the word change is certainly something that was necessary after the financial crisis, and I'm sure that Jérôme in his speech will illustrate a lot of the things that have been done in Europe under his presidency to adapt rules and regulations in Europe in response to the crisis. But of course, one of the elements of change that has negatively affected all of us was the decision of the United Kingdom to leave the European Union. I personally remember how shocked and disappointed I was when I was up, as many of you were, in the night where all the Brexit results came in. But of course, we have to deal with this change. And the initial sentiment of loss and disappointment should not lead us to a lack of realistic assessment of the changes ahead of us, and in terms of the needs for action and needs for decisiveness and needs for constructively tackling these challenges. I think we're all agreed that Brexit is something that we will spend a lot of time on. This year's Finance Summit in Frankfurt rightly takes up exactly this sentiment of change. Our hosts captured it through the conference's title by a straightforward analogy to track and field. Ready, steady, go. Who is ready to set the pace in these challenging times? I like this picture a lot. It clearly attaches a positive element and a positive meaning to a challenge. It focuses on the opportunities that come with this challenge, and in particular, it incentivizes us to get ready and to act now, which is important for both of the topics that I will focus on in a little bit more detail, Brexit and the deepening of the European Union. The UK's decision to leave the European Union is a prominent example for the fact that we cannot always choose our challenges. Moreover, we can make a huge difference to how we deal with these challenges. So in that sense, I think the motto, ready, steady, go, fits neatly into describing how to address the issues. We will need to ask ourselves a lot of important questions. First, are we well enough prepared to start and set the pace? And second, which direction is this run going to take? And when and where are we going to arrive? But of course, this is where the analogies to track and field reach their limits. Our path through Brexit does not yet have clear finishing lines, particularly because a vital decision of the British government and its parliament are still outstanding. Financial industries have successfully mastered uncharted territory many times in the past, and they will continue to do so. Identifying, analyzing, and preparing for uncertainties are integral parts of their business models. Furthermore, we have at least some guidance to what potential landing zones could look like, and I will get back to this question in a moment. But first, let's focus on what should be done now. Are we sufficiently prepared? How can we be sure that we are? There is no doubt that Brexit presents a major burden for the financial services sector. All European and German authorities and regulators are aware of this. Preparations for Brexit demand considerable expenses, resources, time, and effort from all companies and institutions involved. In some cases, they involve massive restructuring. Millions of contracts may have to be analyzed, substituted, or modified. And trust me, I know from my personal experience in my prior job what all of that means when we all together tackled issues like the global margin rules and other big events that forced us to change these millions of contracts, and that is potentially ahead of us again. The EU's and the UK's financial markets are quite integrated today, and that is a very good thing. This is a demonstration of the EU single market's extraordinary success over the last 30 years, which hopefully will continue. From a legal perspective, however, this integration will end quite abruptly in less than a year. We do not have any indications that the British government's decision to leave the common market will be reconsidered by then. As a consequence, UK financial services companies will immediately lose their passporting authorizations under EU regulations and vice versa. Germany has worked very closely with the European Commission and the UK government very constructively for an agreement on a transitional phase, which should give the industry and the institutions more time to develop and implement adequate solutions. It was an important step that the European Council agreed at its meeting in March on such a transitional phase up to the end of 2020. But it is important to note that this agreement is a political agreement, not a legally binding text. In the end, nothing will be agreed until all is agreed. That is a very common theme of many complex negotiations. And of course, it applies to this one as well. There are still open questions, including the questions of a customs border between Ireland and Northern Ireland, which remain to be solved. It also has to be kept in mind that the exit agreement, including the part on a transition phase, will have to be ratified by the European and the UK's parliaments. These procedures are complicated, and their results are not fully predictable. Even though we would wish so at this stage, they simply are not. This alone should be incentive enough for every enterprise affected not to interrupt or to slow down their efforts on contingency measures in the light of Brexit. We hope and work for the best, but it is important that everyone continues to prepare even for the worst-case scenarios that none of us hope will actually occur. Every firm should by now have at least a proper analysis in place as to how it can continue to service its customers and be able to provide clear timetables for testing and implementing the new structures and procedures. Many firms have worked closely with German and European regulators and supervisors in the context of their contingency planning. All of them experienced that these agencies stand ready for assisting them through constructive dialogues. A special thanks in that context to Felix Hufeld, who is here and who we will hear later today. With BaFin, we really have a great supporter of all of these efforts, together with the Bundesbank and the ECB. We are committed to making sure that these issues are dealt with in a constructive but decisive manner. We also welcome that the ECB and the Bank of England have just a few weeks ago initiated a technical working group on risk management regarding financial services in order to prepare for any possible frictions when Brexit becomes effective. Neither national or European authorities should be expected to use public sector toolboxes to substitute for private sector preparedness. It is in the financial industry's capacity to tackle these challenges and their primary responsibility. We will do what we can to constructively accompany that effort. Michel Barnier has vividly characterized Brexit as a lose-lose situation. He certainly has a very valid point with respect to Brexit's adverse political and macroeconomic effects at large. However, from the perspective of Frankfurt, his description may prove to be too pessimistic. On the contrary, if all do their homework, the outlook for Europe 27 and for Frankfurt as one of its major financial hubs may turn out to be much more favorable. If we look at the European level, EU 27 is much less dependent on trade with the UK than the UK is on trade with the EU. We should indeed prepare for negative effects, but we will be able to handle the damage. The European Central Bank confirmed in its financial stability review of last November that the risk that access to wholesale and retail financial services be materially restricted for the euro area economy appears limited. In addition, we will see that Brexit provides strong incentives for EU 27 to revalue its strength, to close ranks, and to push forward with its reform agenda to make even better use of its own opportunities, even in light of the current market volatility. I hope that this will be the case. And if we look at Frankfurt, we see a city in a very good starting position. Frankfurt is one of the continent's leading financial hubs and plays in the league of the world's leading financial centers. It already hosts a significant agglomeration of banks, asset managers, pension insurance companies, and other financial service providers, and of course, Deutsche Börse, one of the world's most prominent and largest exchanges. It is home to many important international and national European institutions and supervisory bodies. It is an extremely attractive location for financial market participants to settle and start their businesses here. And many financial institutions, with the need to strategically relocate business from London to the EU, have already made commitments to Frankfurt. And Frankfurt is prepared. It has understood years ago, even before Brexit, that being an outstanding place for business alone may not be enough. Smart and forward-looking strategic investments have been made into strong cooperation between Frankfurt's community, finance, and academia, among them through interdisciplinary institutions such as the House of Finance, SAFE Research Center, and the Frankfurt School of Finance. As I can testify from prior knowledge, Frankfurt is a great talent pool. The universities in Frankfurt and beyond are a great educational center for future generation of financial and business leaders. Last but not least, Frankfurt and the Rhine-Main region is not only a thriving economic and knowledge region, it also offers healthy environments for a good quality of life and great places for raising and educating children, both in the local school system and in the international schools that this region has. Again, I know what I'm talking about. While Frankfurt and Germany are already good at attracting financial business, it is always possible to improve and to become better. This is why the new federal government has committed itself to establish an attractive framework for the Finanzplatz Deutschland, the Financial Center Germany, To be very clear, in the light of the upcoming exit of the UK from the EU, we want to make Germany even more attractive as a place to do business for financial institutions from around the globe. And by that, we mean that we highly welcome job creation by all financial institutions, global banks, pension insurance firms, asset managers, fintechs, and related service providers in all financial centers in Frankfurt and beyond in Germany. This includes an initiative for making labor law more flexible with regard to certain senior financial sector employees with influence on their employers' risk profile, the risk takers. We understand that this is a factor very dear to the international industry, and we will find a solution here. Financial companies, on the other hand, know that fair and reliable labor law and practices are indeed another asset in terms of stability, not a liability that adds to Germany's attractiveness as a place to do business reliably and stably. But there is no question that London will remain one of the most important financial centers worldwide, and also a financial center of great importance for the EU 27 and Germany. It will therefore be vital for the EU 27 and the UK to continue their current close cooperation. We do not know exactly what this cooperation will look like in the future, but the European Council has, in its guidelines of March 2018, explicitly underlined its determination to have this future partnership as close as possible. And of course, the German government is very committed to contributing to that commitment. In particular, we all share a strong interest in having our regulators and supervisors work together. And we must uphold our strong regulatory and supervisory standards. We have learned from the financial crisis. Neither the EU nor the UK has any interest in regulatory races to the bottom. Quite the contrary. The lesser our rules deviate in the future, the better it will be for our markets. I am therefore very confident that adequate instruments and fora will be developed for an intense future collaboration, not only internationally, but also on a bilateral basis. Nevertheless, the UK's government present decisions, or red lines, not to stay in the EU's common market, to leave the customs union, and to base its future economic relationship with the EU on free trade, on a system of free trade agreements, have reduced the options for possible forms of partnership. As a third country outside the EU common market and customs union, the UK will not be bound by fundamental political and economic commitments like the free movement of labor, nor will it want to or have to follow the EU's legislation and regulation or the European or the EU Court of Justice's decisions. From the EU's perspective, all of these elements belong together as integral parts of the common market to ensure fair competition and to keep its system of market regulation intact. This is why the common market is not available for some selected sectors, such as financial services only. Brexit will inevitably lead us to a new environment with two independent legal systems. Any realistic EU-UK agreement will have to acknowledge both jurisdictions' legislative and regulatory sovereignty, including their power to unilaterally determine or change their own regulatory standards for all financial activities in their territory at any given time. Proposals that EU 27 and the UK should mutually recognize their regulatory regimes as equivalent or even equivalent in outcome without a corresponding right to unilaterally withdraw such recognition in case of new considerations do not adequately recognize this legal and regulatory independence. I therefore doubt that the EU could accept such proposals. Therefore, a free trade agreement indeed seems to be the only available framework for organizing the UK's future access to the EU market and vice versa. For very good reasons, FTAs, free trade agreements, including CETA and proposals for TTIP, explicitly leave all decisions as to prudential standards and regulatory market access to the jurisdictions involved. It should be added that the EU already has a system of regulatory regimes for third countries that addresses exactly the complex decisions to be taken when assessing other jurisdictions' equivalents in the field of financial markets regulation. These regimes are designed to balance the EU's capacity as an open market economy with the need to mitigate risks that for market participants and the financial system. Where new developments, such as Brexit, come with new risk, these systems will be adapted accordingly, as we are doing right now with regard to systemically relevant central counterparties in the context of the EMIR 2 legislation. Let me move to the deepening of the European Union and the initiatives we're taking specifically with respect to banking union. On Italy, I do not have much to add beyond the statements that were clear and constructive by the German Chancellor and Finance Minister. But I would add that to me, the current market volatility, together with Brexit, reinforces the urgency for the EU 27 to proceed with still lacking reforms. We should move forward here, and we are committed to doing so while using the right sequence. Let me illustrate this in a few words as to our ambitions to achieve a strong and sound European banking union. In June 2016, ECOFIN ministers agreed on a roadmap to complete the banking union, which we are very committed to working on and making more specific. This sets out elements and a sequence of further risk reduction and risk sharing. At the Euro Summit in December 2017, there was broad consensus that priority should be given to completing the banking union, the capital markets union, and to further deepening the European stability mechanism. And I think in light of any market volatility that we see, the tool of the European stability mechanism is showing to be vitally important as an alternative of how to deal with market volatility. For that purpose, the Euro Summit mandated ministers to further develop the ECOFIN roadmap on the banking union in order to deepen and broaden it where needed and to add more precision as regards to the specific steps that need to be taken in terms of risk reduction, new instruments required, and risk sharing. The extended Euro Summit will revert to this topic in June, and I'm spending a lot of my time on specifying that and making it more precise, with a view to reaching a first set of decisions and providing additional guidance on the way forward. While we need to further develop the ECOFIN roadmap, we also have the clear mandate to adhere to this map. The sequence set out in the ECOFIN roadmap remains unchanged. We first need to further reduce risks before a potential early introduction of the common backstop for the Single Resolution Fund can take place, and before political negotiations for a European deposit insurance can start. Progress has been made, but work still needs to be done. If we wish to make swift progress, we need to specify the necessary risk reduction measures now. As set out in the ECOFIN roadmap, risk reduction includes reducing existing and prevention of future non-performing loans, improving the efficiency of insolvency regimes where necessary, and building up sufficient bail-in buffers for banks. In this context, the agreement on the banking package with a substantial requirement and harmonization of minimum required own funds and eligible liabilities, namely bail-in capital, is a very, very substantial step forward to achieving this element of risk reduction. And we are committed, on the other side, to not to demand further risk reduction as a means in itself and as a sole instrument to stop progress on further deepening of the Eurozone. No, we are very, very committed already in June to make the next step forward, specifically on deepening the banking union by defining and formulating a solution for the common backstop, potentially moving it even ahead of the 2024 target set out in the roadmap. And I think the speech that Finance Minister Scholz gave in the Bundestag on this topic illustrates that the German government is very committed to doing this and to implementing it with the aim of reaching a conclusion already in June. We need to set clear, ambitious, and measurable quantitative targets and benchmarks for risk reduction measures, which are important. These need to apply for all member states. Mere ranges, trends, and processes are not sufficient. And I think the solution that we found on Friday on the banking package, which was based on a German-French proposal to the presidency, is a very good example of how this can work. And the fact that we found agreement on this is a very, very positive sign. And I have to say the sentiment in the ECOFIN meeting, it was a public, even live streamed, so you can take a look at it, where after the agreement was reached, all ministers got up to applaud for this very, very significant step towards deepening of the banking union and the European Union in general, shows that the power of Europe exists in light of all doubts and volatilities that we have surrounding us. The German government has affirmed its ambition that the European Stability Mechanism should advance further. So this is what we are working on now, that the banking package has been decided, a significant step towards risk reduction and expansion of bail-in capital, together with other interesting and sensible measures such as proportionality with respect to smaller banks has been achieved. So great step forward, more to be done, and we're committed to doing this in June. The ESM is a very important tool for this, and Jérôme has spent many hours and many years of his life as one of the big architects of this tool that we now have in Europe, and that we are committed to expanding in the direction of making it a much broader tool and developing it in the direction of a European monetary fund. Although the ECB, for very good reasons, does not want us to call it a European monetary fund, because of course it will not have any monetary tasks. The ESM may, as a last resort, be the right place for the common backstop, which is a very important tool to complete the banking union and the resolution tools that we have set up in the Single Resolution Fund and the Single Resolution Board. And as I said, we already agreed to introduce this common backstop by 2024 at the very latest, and we have agreed that we could potentially foresee implementing it earlier. We need to address all of these ESM reform issues together in one package. This is important also, even though the time pressure to get this done in the next few weeks is challenging. We are committed to not only find an agreement on the common backstop, but also to include an enhanced role of the ESM in designating and monitoring programs, and also an appropriate review of the ESM toolkits to make it more workable in the direction of having the capacity to act as a European monetary fund. In addition, we should examine further options to fully ensure debt sustainability. And of course, we need to preserve the role of the national parliaments. We are fully committed to delivering results by June, and we are hopeful that the spirit of European cooperation that we saw in action last Friday will continue. Given the high level of risks in the banking sector as of today. We also consider the European Deposit Insurance Scheme as a very ambitious and rather longer-term project. It is vital that member states significantly and sustainably reduce risks first, so we see EDIS as a much, much longer term and at the moment unrealistic proposal, but we are committed to working further, specifically if and only if further risk reduction measures take place. Ladies and gentlemen, the strengthening of the banking union, like Brexit, is a major challenge that should by no means be underestimated. But the stability of banks has improved significantly in the last few years, and I am very confident that banks will be able to address the remaining work. And it is very encouraging that all countries agreed on two things. One, we have made great progress in risk reduction in the past in almost all of the EU's countries, and we are committed to continuing on this course in terms of risk reduction. And on the other side, we are committed to using the progress in risk reduction to make further steps and further progress on the deepening of the Eurozone and the deepening of the banking union. So with that, many thanks, and I look forward to working with a lot of you and many of you over the next coming years in my new role. Many thanks.